Hi, I'm Craig Navor with Paragon Capital Management. Today we're going to be talking about an investment called structured products. This is going to be a three-part video series in which we're going to discuss what are structured products and how do they work. In the next video, we're going to talk about growth notes and how those can work as a replacement to your stock portfolio. And in the third video, we're going to talk about income notes or callable yield notes, which can be a replacement to traditional bonds. So what is a structured note? A structured note, in its essence, is a senior unsecured debt issued by one of the major banks in the world. There's about 14 to 15 major banks that issue structured notes. Some of the more common ones are names like Bank of America or Goldman Sachs or Morgan Stanley, JP Morgan, and others. So what does senior unsecured debt mean? Within a debt ladder, that describes what would happen if an institution or a corporation were to go bankrupt. Who gets their money first? So if we look at this diagram of a debt ladder, at the very bottom of the debt ladder are going to be common stocks. Next above that would be preferred stockholders. And then you've got your common bondholders, then your junior debt holders, and then we get to our senior debt holders. Within the senior debt holders, we have our senior unsecured, which is where these notes come into, and our senior secured. One of the things that we try to describe when we're looking at structured products is what affects pricing. And two of the major things that affect pricing are interest rates and volatility. Volatility is typically measured by an index called the VIX, V-I-X. It's something you can look up on your computer, and typically the VIX will be in a range somewhere between around 10 to 12 on the low end and 30 to 40 on the high end. When the market goes down, that creates more volatility, and when the market goes up, it creates less volatility. Structured notes are a hybrid investment. It's basically a zero coupon bond with some form of an option strategy. Those options are priced primarily based upon the interest rates and the volatility, and so the higher the volatility, typically the better terms that we can negotiate when creating the notes for your account. Each of the major investment firms creates calendars of notes that they then email out to a lot of different brokers, money managers, registered investment advisors with different terms that they are offering. And those notes could be issued anywhere from a couple weeks after the calendar goes out to a month after the calendar goes out. So if you look at this illustration, we can show that on day one, the calendar is created, and they're going to create those notes, let's say, at the end of the month or 30 or 31 days later. The trader has to figure out what are those options going to be priced at that time. And the markets could do anything. They could go up 30%. They could go down 30%, like we saw back in March and April of 2020 with COVID. So you got to take in those huge extremes into account so you're not promising terms that you can't deliver. Whereas with Paragon, what we're doing is we're going out early in the morning, usually around 7:30, 8 o'clock Central Standard Time, and we are contacting those banks through various different sources, giving them the terms that we would like to create for our clients, and asking them to bid on one of the different aspects. Typically, most notes have three different parts to them. They have a duration, which is when it's going to mature. They have an upside, and they have downside protection. So we're going to pick two of those terms that we want to control, and we're going to have all the banks bid against each other on the third part, creating competition and hopefully better terms for our clients. We're going to get those bids back usually around lunchtime, around noon, if you will, Central Standard Time. And we've got to have those locked in and back to the brokers by 2 p.m. Once we lock in the terms, they will then go out and create those notes and execute those option strategies before the market closes at 3 p.m. The reason I'm telling you this is when you look at it from that perspective, the trader really has about a 2-hour window that they have to worry about market movements versus a 2 weeks or 30, 31 day, depending on how long those calendars are. So there's less risk when pricing the notes, which helps us to negotiate better terms. Some of the other things that are of concern when you are looking at notes and different people who do them are fees. If you go to a a commission broker, you could be paying a front load, and you could be paying some kind of fee on the back end. At Paragon, we never ever have a note with a front load, and all of our notes are what we call uncapped, which means there's never a limit on how much you can make on the back end. The third major fee category is the underwriting fee, and that is right usually on the first page of the contract or on the second page of the contract that is issued by the bank or the note that tells you what that bank is charging and what the fee that they are embedding into the note. And that could be anywhere from a few basis points up to 1%. And so our goal is to reduce that as much as possible, therefore getting better terms for our clients. One of the other things that's very important when talking about notes, and we'll talk about these when we get into video 2 and video 3, but is the risk management. So when we're talking about downside protection, there's a lot of different ways to do that, but the two major ways are what's called a buffer or a barrier. In my mind, a barrier is a little bit riskier, and we'll use those on the income notes, but a buffer is what I like to describe as a hard protection. That means that the downside is locked in, and it gives you a little bit more solid protection from a down market. And I'll explain how both of those work in future videos. The other part that can increase or decrease risk are the type of options that are used. Now, options are very complex, and that could be a whole video on its own, so we're not going to get into too much of that. But there are American options and there's European options, and we think that the European options are less risky, and those are the ones that we always price in. One other quick thing when we're talking about options, and we're not going to get too much into this either, but there is another term you might see if you're talking to different people about them, and that is a term called gearing. Gearing is kind of a options term for leverage. And a lot of times you might see gearing on the downside, which means leveraging your risk on the downside, which is something that we don't do here at Paragon. Our goal is to reduce risk, and we try not to use things like gearing, which could increase the risk if the markets were to go down. The other major part of a structured product is it has to be benchmarked to something. And that something could be anything that you could buy options against. It could be individual stocks, it could be indexes, it could be currencies, commodities. There's a lot of different ways you could create notes depending on what your risk level is and what you're trying to achieve. We have always used broad-based indexes such as the S&P 500, the Dow Jones Industrial Average, the Russell 2000, the NASDAQ 100, the Euro Stoxx 50, things that are very broad-based. A lot of times what we'll see with some of our competitors is that they'll create notes using some very high-risk stocks, and the terms are much better, but you're increasing your risk. And so what we want to do is reduce that as much as possible. We also will use a term called worst of. And what that means is we might have more than one index, so we might do the S&P and the Dow, or the S&P, the Dow, and the Russell 2000. And when we're looking at that benchmark, we're going to be using whichever one of those performs the worst or the least performing of the three indexes. And it's very important if you're going to pick multiple indexes that those indexes are correlated to each other, which means they perform very similar. A lot of times we'll see notes that will have like the S&P and the Dow, but then also have something like gold or something that is non-correlated, which increases the volatility and can create better terms, but it also increases the risk. Hopefully you found this video informative, and hopefully it raised some questions, and you'll check out our second and our third video and learn more about how the actual notes work as we discuss both our equity replacement, our growth notes, and our income replacement for fixed income as we look at the callable yield notes. Once again, I'm Craig Navor with Paragon Capital Management. We appreciate you taking the time to watch this video.